Hey everyone, I'm Jun, a researcher with The Expert. For more than 10 years, Uber and Lyft spent billions of dollars in a bid to capture market dominance. However, their attention has now shifted towards achieving sustainable profitability and exercise fiscal restraint. Let's delve into their latest financial report to assess their progress towards these goals. Uber and Lyft, those big names in the ride-sharing game, have surprised everyone by getting closer to making some serious cash. Despite years of bleeding money, they are finally turning things around. Back in the days, thanks to a flood of easy money, Uber and its rivals splurged billions trying to dominate the market. From 2016 to early 2023, Uber alone piled up about 30 billion in losses, according to S&P Global Market Intelligence. But in 2023, Uber hit a major milestone. It turned a profit for the first time since going public. Their Investors' Day was like a victory lap, with their stock shooting up 15% as they laid out their plans to keep the cash flowing. Dara Khosrowshahi, Uber's big boss, was all smiles, owning up to past doubts while talking up their bright future. Meanwhile, Lyft, the little brother in the ride-sharing world, made its own wave by predicting it would finally start bringing in more cash than it spends this year. It's not exactly profit yet, but investors are loving the optimism, especially after Uber's success. David Risher, Lyft CEO, couldn't hide his excitement, calling it a major win for the team. He came on board just last year to help steer the ship towards financial stability. Now, let's dig into their recent earnings reports and see what's really going on behind the scenes. Uber delivered another impressive quarter with growth ramping up to 21% FXN, hitting the upper end of its projected range, while the EBITDA of 1.28 billion exceeded guidance for the 10th straight quarters. It fell just shy of what investors were hoping for, hovering around the 1.3 billion mark. Looking forward to the first quarter, the forecast was mostly in line with or ahead of expectations, with revenue guidance of 18 to 23% FXN growth is slightly wider than its recent periods, reflecting the company's expanding scale as it kicks off the new year. Uber saw a surge in user numbers and activity across both its platforms, with monthly active platform consumers and monthly trips per MAPC hitting record highs. Trips spiked 24%, outpacing gross booking for the fourth consecutive quarters. This growth is fueled more by increased volume than by pricing adjustment, as Uber aims to keep price competitive while still boosting margins. Their strategy leans on product improvement, a well-balanced marketplace with a record 6.8 million drivers and couriers, and the growing popularity of Uber One membership, now boosting 19 million members across 25 countries. The company's performance in the final quarter of 2023 signals continued robust demand for its ride-sharing and food delivery offering. Total transaction value on the app shot up 22% to 37.58 billion, with Uber revenues from those transactions climbing 15% to 9.93 billion, slightly surpassing Wall Street's estimates. While incremental EBITDA margins might dip slightly after years of strong performance, Uber is still expected to outshine its target of 7% margin. Projections point to around 8% for 2024, with EBITDA of $6.1 billion, comfortably ahead of the previous $5 billion target. Overall, the fourth quarter results haven't changed the game much, and confidence remains high in Uber's ability to execute its growth plans, enhance GAAP profit margins, and generate free cash flow. Uber expanded advertising on its app over the past year. It says it has continued to become more disciplined about spending on discounts to consumers and incentives to drivers. It says it has also begun better at combining deliveries and reducing errors, which have improved its operation efficiency. Looking forward, Bloomberg's data paints a rosy picture for sustained growth in key financial metrics for Uber. Free cash flow, earnings per share, EPS, and net income are all expected to continue on an upward trajectory. Uber stands tall as the undisputed champ in two booming sectors, ride-sharing and food delivery. Armed with its massive reach and top-notch tech know-how, Uber isn't just resting on its laurels. It's diving headfirst into new ventures and scaling up at lightning speed. We are betting on Uber to not just weather the storm, but to emerge even stronger on the other side. Here's why. Uber's domination in ride-sharing spans the globe, giving it a solid edge in every market it serves. Second, as more folks hop on the food delivery bandwagon, Uber's delivery arm is poised for steady growth. Third, with its knack for expansion, Uber is eyeing other lucrative markets like grocery, convenience items, and alcohol delivery. Fourth, thanks to its massive user base, Uber has the potential to rake in significant EBITDA and free cash flow, especially with profit margin of around 10% for mobility and 5% for delivery. Fifth, the introduction of Uber One could be a game changer, driving up usage and keeping customers coming back for more. Sixth, with a robust balance sheet boosting 5.4 billion in cash as of Q4 2023, Uber's financial foundation is as solid as ever. Given Uber's promising outlook and the multitude of growth opportunity it's poised to capitalize on, analysts are setting their sights high. Projected target prices for Uber stocks are predominantly in the range of $85 to $95. It's a reflection of the confidence in Uber's ability to harness its strengths and navigate the evolving landscape of its industry. Now, moving over to Lyft, Lyft shares soared by a whopping 35% to $16.39, marking its highest close in over a year, riding high on a positive outlook despite a hiccup caused by an embarrassing earnings typo that accidentally inflated its profit margin with an extra zero. The company projected stronger than anticipated bookings for the current quarter and expressed confidence in achieving positive cash flow by 2024, indicating that it will generate more cash than it spends, a metric often used to signal potential future profits. Although Lyft has yet to return a profit, it has been steadily reducing its losses. The positive momentum aligns with the trajectory seen in its competitor Uber, which reported its first full year of profitability in 2023 after achieving positive cash flow. Investors welcome Lyft's optimistic outlook, drawing parallels with Uber's journey towards profitability. Analysts at JP Morgan expressed optimism about Lyft's strategic initiative aimed at boosting demand and improving profitability. However, they emphasized the importance of consistent execution for Lyft to truly distinguish itself in the market and gain market share. Under the leadership of its new CEO, Risher, Lyft has implemented various measures including workforce restructuring, the introduction of new features for both riders and drivers, and a push for employees to return to office premises. Additionally, Risher is also exploring divesting non-profitable segments of the business, such as Lyft Bike division, despite its popularity among customers due to its insufficient revenue generation. Just like its counterpart Uber, Lyft could see a shift towards positive earnings per share (EPS) and net income in the forthcoming quarters, fueled by encouraging trends in free cash flow. Unlike Uber, where analysts tend to have more positive sentiments, opinions on Lyft are more neutral, with target price ranging typically falling between $12 to $20. Both companies are adamant that they won't continue hemorrhaging cash as they have in the past. Investors are optimistic that this shift will mark the end or at least a reduction in the aggressive discounting and price battle that previously resulted in significant losses. The days of extravagant promotions are behind us, remarked Pierre Dimitri Gorcotti, the head of Uber's delivery division. We are entering a new phase where the sustainability of the business model is no longer doubted, stated Youssef Squali, an analyst at Truist, where he covers both companies. He likened ride-sharing to a utility noting that customers are willing to pay for the service even as it sheds its reputation for being inexpensive. The focus now, he added, is on understanding what margins this business can sustain as it matures. Thanks for joining me today. I hope you have gained insights from today's video. Everything I've shared are informations that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risk. If you find this video helpful for your research, don't forget to share it with your friends as well. They might find it useful too. Quickly access to all our channels by scanning the QR code. Take care, and I'll see you in the next episode.